Welcome to our 2021 webinar series. LLIS believes that in 2021, knowledge is key. Each month, you'll learn key insurance solutions to better your insurance knowledge. Our insurance specialists keep up to the constant changes in the insurance industry, especially during a pandemic. Our specialists will review some basics, use case studies to show how LLIS crafted risk management strategies, and answer your insurance-related questions. Each webinar will last about 50 minutes, and you must be logged on for the full 50 minutes to receive CFP credit. Please be sure to ask questions as you have them by typing them into the questions box. Today's webinar is being recorded and will be posted on our website within a week in case you missed it. Today's presenter is constantly monitoring the insurance and financial services industry to ensure you and your clients are getting the most up-to-date recommendations. Here to finish our 2021 webinar series is Mark Maurer.
Thanks, Claudia, and thank you to everybody for tuning in today. It's been a strange year, but I'm glad that all of you have kept with us, kept with our webinars. I hope everybody really enjoyed the one last week. Pretty sure it was last week. Days don't mean much this time of year. Last week about Washington State, the long-term care changes there and potential changes going forward. So hopefully everybody enjoyed that one, and we'll try to have some fun guest speakers next year as well, and we'll have some guest speakers at our Insurance Academy here in Florida at the middle end of February. So thank you everybody for staying with us, and we're going to jump into our last webinar of 2021, talking about insuring those you love with joint coverage. So we do a lot of things to show love to those around us. And right now, especially with the holidays, that means presents, that means spending time together, that might mean baking cookies together, that might be listening to the same story that somebody's told you 4 or 5 or 6 times over the years, and smiling and nodding like it's the first time you've ever heard it and it's the most fascinating story you've ever heard. All of those things are ways we show love. But really, does anything show love more than insurance? You're probably all shaking your heads. Yes, there are other things. But insurance really is an important way that we show love. It protects our families in the case of an early death. It protects our assets from being spent down. It provides a legacy to our kids, to a charity. So insurance, I think, is a neat way to show love. And let's talk about how long-term care can do that. Let's talk about a traditional long-term care policy. And as many of you are aware, when you apply for a traditional long-term care traditional long-term care policy, a couple gets discounts. So some companies have a discount if one spouse or partner is applying and the other isn't. Maybe the other doesn't have great health. And so there's a discount by having a spouse or a partner. If both spouses or partners apply at the same time, then there's an even bigger discount, because the idea is that if there's 2 spouses, 2 partners, they're together, if something happened to one spouse or partner, there's going to be that the healthier spouse partner is going to help provide some of that care. So the payments on the long-term care policy may not start as quickly as if somebody was single, may need less care than someone who's single who needs care all the time. So there's discounts for couples applying together with traditional long-term care. So it's just a neat thing there. So when we talk about couples applying together, financially, it's actually beneficial because of those discounts. But how does it show love? Well, let's talk about a mom and dad. Parents, they purchase long-term care insurance because if they need care, they're going to access that long-term care policy to pay for those care expenses. If they didn't have a long-term care policy, they need to use their current income, Social Security or pension income, or start drawing down on their assets. And so it protects mom and dad's assets from being exhausted. That's great. That's how we show love, because mom and dad taking care of the long-term care planning, having that insurance, using those long-term care assets and instead of spending their other assets may be the difference between having to move in with their kids or not. And now I'm not talking about sometimes people move in with their kids because they want to. I'm talking about have to. There's no other money, need to sell the house. Long-term care policy can protect that sort of situation for parents and their kids. It also protects kids from having to become caregivers. Again, having, not becoming. Most kids are going to want to help care for their parents, at least at some point, but maybe not be the primary caregiver. And so a long-term care policy has money available should mom, should dad need long-term care, that's going to pay for home health care aides, assisted living facility, people to come help with those things so that the kids don't have to become caregivers. They may be care managers, care supervisors, maybe even part-time caregivers, but may not have to be the primary. And the Center for Retirement Research at Boston College did a study and found that 6% of adult children already are serving as caregivers for their parents. That seems like a fairly small percent, but take it a little bit further, that 17% are going to take on this role at some point in their lives. And as we have an older population right now, baby boomers, I believe I read something that a lot of boomers are turning 80 and starting to do that in larger numbers every year. It's much more likely that people in their 40s, 50s, they start to become caregivers. 17% are going to take it on at some point in their life. And just looking around our office, I know of two of our people, we have 25 people, maybe 26. Two of our people have parents who live with them full time. Another one who is the primary caregiver. So 17%, that's 3 out of 25, so 17% might even be a little low. And of those who do provide care, they devote an average of 77 hours per month. And it can take a toll on the finances or health. Why? Well, if somebody, these might be 77 hours that somebody's doing outside of their normal work, and that can impact their health. When are they sleeping, spending time with their kids? Maybe they have to take time away from work to provide some of those hours every week. And that can be an impact on the finances. And as I mentioned, that burden is going to become a bigger concern as the boomers move into their 80s. So all things, having a long-term care policy doesn't prevent anybody from needing care. It provides that funding so that it provides the funding so other assets aren't spent down, exhausting assets so that they have to move in. And a long-term care policy provides information, people, access to care providers, people who can help with the care. Most long-term care companies' policies have preferred provider lists, people who've gotten good service through different places and areas of town. So that's another, it's just almost a built-in referral network for some of those things as well. So kids can be care managers, care supervisors, not necessarily the caregivers. So here's Stan and Fran. They live in Cincinnati, Ohio. They have 2 kids in college. They're in their mid-50s. And right now, it's an ideal time to look at long-term care insurance, long-term care planning. How are they going to be able to offset that should either of them need it in their financial plan? Why do I say it's an ideal time? Well, in our experience, somewhere about mid-50s, kids are into college, out of college, and people in their mind, I think a lot of us just got to get the kids out of college. And all of a sudden when that happens, you think, oh, well, now my next thing is retirement. And so for a number of years, when you have kids, they're expensive. College is expensive. So really what you're trying to do is just keep up with your expenses with your income coming in. About college age, a little bit right after, now we start to think more about how I'm getting concerned maybe about distributing. How am I going to spend down my assets in retirement rather than having enough in retirement? So not necessarily there yet, but our mindset changes a little bit. And people in their mid-50s are more likely than people in their 30s or 40s to have a personal experience with long-term care. Now, probably not themselves, but may have been caregivers for mom and dad. Maybe their aunt or uncle is having some care needs and their cousins helping with it. So becomes when parents are in their, kids are 56, parents are in their late 70s, 80s, that's about the time these things happen. So it's a good time when I think it becomes real to clients. And the numbers back us up. This is the most current number I can find, 2009, but over half of new long-term care insurance buyers were between 55 and 64. So not people in their 30s. It's not real yet because their parents are now in their 60s. They're still out there doing stuff. It's still real. It's not real yet. And it also helps to apply sooner. So for Stan and Fran who are in their 60s or mid 50s, they've got about a 46% chance of applying on average, of getting approved for coverage. So right about half. The younger you are, the less likely you are to have had your first heart attack or had a bout of cancer. 62% of people who apply 40 to 49 get approved. And if we go from 60 to 69, it's about 38%. So really it's like 60% in your 40s, 50% in your 50s, 40% in your 60s. And it just declines from there. A lot of companies don't offer coverage, sometimes in the older years. So the earlier people apply, the better. Rates are lower because they're younger, likely healthier than waiting too long. Now, Stan and Fran are in Ohio. One of the things we do is we look at what are the costs of care in their particular area. If they lived in certain areas of New York, these numbers would be a lot higher. I think Alaska is maybe the most expensive place to receive care. Oklahoma, I think, is one of the lowest. So knowing what the costs are wherever they are or where they plan to retire helps us figure out what's a good amount of coverage to create a baseline. A 2019 study found that almost 70% of long-term care claimants start receiving benefits in their home. So these are people who had long-term care policies of some kind. Could be a combination policy, individual policy. 70% of them started receiving care in their home. When they turned on that policy, they were getting home care benefits. So that's 70%. So if we wanted to look at that sort of number, we look at the top left, in-home care averages 2020, $4,700, $4,800 per month. Another 18% started receiving benefits in an assisted living facility, $4,750 a month. So that means 1 in 10 people started receiving long-term care benefits in a nursing home. So that's the much higher $8,000, $9,000 a month. Now, let's look at what's more likely to happen. More likely to happen is that when your clients go on claim, their benefits they're going to need, using today's numbers, are somewhere around the high fours, $5,000 a month range. So that's what we would look at as a policy here for Stan and Fran. In 80%, almost 90% of the time, if they start a claim, $5,000 a month would be the right amount, would be enough to cover most of their expenses. For the 1 in 10 chance that maybe they start care in a private nursing home, they go on claim, they'll still get $5,000 a month from the policy, and they have to come up with the shortfall, that $4,500 for the private room out of pocket. So we're sort of self-insuring the additional costs of a nursing home, knowing that that's people, and this is for people who start receiving benefits. A lot of people start benefits, start receiving care in their home, and they eventually transition to a nursing home. But normally, this home care may be a longer period of time, private nursing home, a shorter period of time. But using the $5,000 a month, we kind of get to say, no matter where they use benefits, we will probably use the benefits of this policy fully. They may need to pay more for certain types of more expensive care, but we're not overpaying for a policy, not having a $9,500 a month policy that they may not use fully 90% of the time. If all they needed, whatever was home care, and had $9,500 a month, they pay for access to that $9,500 a month, so they're really paying for more than they might need. So for Stan and Fran, let's look at a 90-day elimination period. That's how long they would self-fund the initial needs for care. After 90 days, they're eligible for $5,000 a month with a 3% compound inflation rider. So hopefully that $5,000 per month today buys the same basket of long-term care goods in 10, 15, 20, 30 years. 3 years of benefits each with the shared care rider. And so that's a combined total of $5,500 per year for Stan and Fran to each have that coverage. Shared care is a really neat thing that we get to do with spouses. The average time claim for women is a little over 3 years. Average time of claim for men, a little under 3 years. So by having a shared 72 months or 6 years, we build in a little flexibility. What if one of them actually needs 4 years of care? Stan needs 4 years of care. He's more than the average. Then he can access his 3 years of benefits and potentially then dip into her policy for a year, leaving her 2 years of benefits. So it adds some flexibility and that combined premium. So one neat thing that happens though is if one of the spouses passes away, the surviving spouse gets to keep the deceased spouse's unused benefits, and premiums reduce to what just his or her share of those premiums would have been. So in this case, what happens if Fran, they have the policy, 6 years of 3 years each, 6 years, 72 months of shared benefits, and Fran passes away? Her 36 months get added to Stan's policy. So he has 72 months of benefits. And his premium decreases from $5,500 a month to what his share would have been, $26.91. So he got all of her unused long-term care benefits and his premium went down. Now, women tend to live longer than men, and so more than likely, it's going to happen the other way around, that Stan is going to predecease Fran. But say he never used his long-term care benefits. Now she has a 6-year benefit period, and her premium is reduced by $1,100 a year, down to $4,400 a year. So either way, the surviving spouse, the unused long-term care benefits of the deceased spouse jump onto the surviving spouse's policy, and the premiums for the surviving spouse go down. And for Stan, it's or Fran, but again, using the averages for Stan, the shared care rider is a way to show love even if or when he's gone. Because in that case, if he's not there, any benefits that he didn't receive jump onto her policy and the premiums go down. And we talk about long-term care insurance quite a bit for you and your clients. And it's still sort of the baby in the insurance world. But what are the odds that somebody might need different types of insurance. And I found a study that says the chances of using your homeowner's insurance are about 1 in 88. Odds of using your auto insurance are about 1 in 47. But the odds of a person using their long-term care insurance policy are about 2 in 5. With numbers like that, why does not everybody have long-term care insurance? We just said that I've got a 2 in 5 chance. I got a 40% chance that I'm going to use my policy, but I know I have auto insurance and I know I have homeowners insurance, and my odds are much less. Well, one, I don't know that people think of long-term care need as being as catastrophic as your house burning down. But we're still talking about potentially hundreds of thousands of dollars. We also don't necessarily think about our health in 20 or 30 years, where our car insurance, we drive a car every day. What's the other thing? If I want to get a mortgage, well, my mortgage lender is going to make sure I have a homeowner's policy. It's required. If I want to drive legally in my state, auto insurance is required. So the first two are required. This long-term care insurance isn't. And so those are some of the odds. We're much more likely to use it. And nearly 70% of 65-year-old people who are 65 years old today, are going to need long-term care support or services at some point in their lifetime. Women typically need care for an average of 3.7 years, while men require it for about 2.2 years. So it may have been a little off, a little closer to 4 years and 2 years, but we have that 3 years with shared care, 6 years. We're right in that number where we've got our averages. But even with all of that, even though I just said it's a 2 in 5 chance that we're going to need long-term care, and really it can be a catastrophic expense for care, $50,000, $60,000, $70,000 a year. One of the questions is still always, why pay for something I may never use? Well, we might have that argument with homeowners and auto insurance, but it's required. Long-term care, it isn't. So how do insurance companies understand that that's something that clients go through their head? So what did insurance companies do? Enter the hybrids. Everybody like that? I had fun with that. Thank you, Claudia, for making that look good. Enter the hybrids. What are hybrids? Hybrids are combination policies. Life insurance with a long-term care rider, or an annuity with a long-term care rider. Hybrid, it blends two things together. So let's look at Stan and Fran, and we're going to talk about a hybrid life long-term care policy. We're going to get as close as we can as possible to the traditional long-term care policy. So we've got similar long-term care benefits, $5,000 per month each initially. Same, a shared 66 months. So this is 5.5 years instead of 6 years. Pretty close. Close enough for horseshoes and hand grenades. We're pretty close. Same 3% inflation rider on the $5,000 per month benefit, the long-term care pool. So we're pretty close here. So what do we notice here? First, that's a much higher premium. $10,000 a year instead of $5,500. So that's a consideration there. But now we've added a death benefit protection, and this is a joint or second to die policy of $166,667. So if they never needed long-term care, Stan and Fran never needed long-term care, they would have paid those premiums, and their beneficiaries, so this would be not either one of them, because it only pays when the second of them is deceased, their kids, their church, their synagogue, their charity, the ASPCA, whatever, or whoever they want to leave their money to. So they pay those premiums. If they never needed long-term care, well, then there's a $166,000 death benefit that passes on to somebody. But if they need it for long-term care, they have those $5,000 a month for 66 months, so a $333,000 long-term care pool, growing at 3% every year. So similar long-term care benefits with the backup of the life insurance death benefit. If we look at the premium difference, $10,737, or long-term care policy, $5,500. It's about a $5,000 a month benefit, or $5,000 per year. It takes about 33 years for that $5,000 to make $167,000. So in one way, you might be able to save and have that create your own death benefit. But at the same time, if mom and dad passed away after a year or two, then they wouldn't have had time to do that. So it's just a way to be able to provide that long-term care coverage for someone who's hesitant to pay for a traditional long-term care policy, like health insurance, auto insurance, homeowners insurance, lots of different types of insurance we pay for that we hope we never use, and really are never going to get anything back out of it. I would love to get something back out of all my health insurance premiums that I've paid over the years. I know I'm not going to. So, just too bad. So if a client may not do a traditional long-term care policy, even though you can say, well, and save the extra $5,000 and you'll have maybe a similar pool of money to pass on to your kids in 30 years, this is a way to help them get over that hump to say, and if you never need it, there's going to be a life insurance death benefit. One question, is hybrid always more expensive? Always is I never like to say always, but 99.99% of the time, yes, because we have the same long-term care coverage, but now we've also added the fact that the insurance company has to give somebody back something at some point in time, even if it's a death benefit. So if the insurance company gets to keep the premiums and pay benefits in the future 40% of the time, or I get to collect premiums and I'm going to make sure I know I'm going to have to pay something, whether it's long-term care benefits or the face amount, then there's going to be additional expenses for that. So what did we get? Really? Well, we got double benefits. There's the long-term care benefit if they need long-term care, and we have the life insurance death benefit that is a backup. If they never use it, then their kids are going to get $167,000 death benefit. Oh, and like with the shared care policy, this again is a shared 66 months of benefits. As a second to die policy, when the first spouse passes away, the policy still keeps going. And so the spouse can continue to receive, if the first spouse never used any benefits, then the surviving spouse has 66 months of benefits. And when that second spouse passes away, then the beneficiaries are going to get that $167,000 minus any benefits paid. And so I think that's important to know, that it's not that the kids will get 167 if even if they paid long-term care benefits. It's 167,000 minus any long-term care benefits paid. So the 167 would only be if no long-term care benefits were ever accessed. If mom or dad used $100,000 of long-term care benefits over the course of the policy and then passed away, then the kids would get the remaining 67,000. If mom and dad used 300,000 of the long-term care benefits, then there's no death benefit. The policy paid out more than that backup, in quotes, death benefit. So what's another reason people buy life insurance? Maybe because they want to make sure that they have the long-term care planning, but have a make sure somebody's going to get something out of the policy. What's another reason? 53% of people say they want to use life insurance to transfer wealth or leave an inheritance. And this was from a 2021 insurance barometer study by LIMRA, which is, I forget exactly what it stands for, but it's the big insurance company group. 53% of people said they plan to use life insurance as a way to either transfer wealth or leave an inheritance. That's another way of showing love. When we moved to Tampa, when I was in 3rd grade, we'd left my grandparents in Nebraska. And when we moved to Tampa, the couple across the street from us, when we moved in, I was in 3rd grade, they were grandparent age to me and my brother. And so they became our grandma and grandpa Demery. And they were regular parts of our lives for many years. And as my grandma Demery got older, one of her concerns was making sure that she left life insurance to her son. Now, her son was a successful CPA in Atlanta. He didn't need the policy. He didn't need the death benefit. But to her, leaving something to her son was something that she was important to her. And so that's a way to show love. It was important to know that she left him something. He didn't need it, but to her it was important. So people are going to want to make sure they leave their kids something. And life insurance is a good way to do it. It has a number of benefits. Mostly one of them is that it's income tax free to the beneficiaries. So it's a great way to transfer wealth or leave an inheritance. We're gonna look at some things that make it even cooler. We're talking about couples, talking about showing their love as couples. A survivorship or second to die life insurance policy is a neat policy. It's one life insurance policy that covers 2 people. And this is always going to be permanent life insurance. At points in time, insurance companies had these as term policies. No one I'm aware of has these anymore. And partly because with our current estate tax limits of north of $20 million, there's a lot, the majority of people don't have estate tax planning concerns. They may have estate planning concerns, and we're going to talk about that here in a second. Estate tax planning is purely involved with estate taxes. Estate planning is, how do I want to leave what I have to people? Survivorship or second to die life insurance is a good way to work with the estate taxes if your estate's big enough, but it's also a good way to work with the latter of just, how do I leave stuff to my kids, more than likely. Well, with a survivorship or second to die policy, is one policy covering 2 lives, and 99.9%, kind of whoever asked about always, not always, but 99.9% of the time, it's going to have the lowest premiums for a specified death benefit. If we want to leave $1 million life insurance policy, then there's going to be, by covering 2 people, it's going to have a lower annual premium than covering 1 person for that straight $1 million. Oh, I had a question about Stan and Fran. So can you please explain again, if there is a shared benefit and a different in ages in spouse, if the older one uses up all the benefit, then does the younger one have nothing? That's correct. So in that specific example, 3 years of benefits each, there's a shared 6 years of benefits. So if the older spouse uses all 6 years, then there's nothing left for the survivor. Some policies, I believe, have some almost residual that says even if you use up all of one, there may be a little benefit for the surviving spouse, but for the most part, that's correct. The older spouse might use their 3 years, then access the 3 years for the younger spouse, and then leave essentially have exhausted both the policies. So good question. All right. Back to survivorship life insurance. Whew, gotta recalibrate my brain there for a second. All right. Glenn and Donna, they're both age 55. They have a net worth of about $12 million. Today, this is not an estate tax planning concern. Now, with a lot of the tax changes that are out there and potentially lowering the estate tax limits, could it be at some point in the future? Maybe. So it's not the major driver for this part of the discussion of the planning, but if we can find a way that actually reduces their taxable estate in the future potentially, then it's just a double win. They have 3 kids, and they want to leave their kids $1 million each. They want to make sure that they leave them $1 million each. Now they can do that with assets, and at this point, they'd have to leave $3 million worth of assets. It's okay, but what if there's another way to go ahead and do it without having to leave that much in their portfolio? How about a $3 million second to die life insurance policy? I think it's going to be a good idea, but I'm giving the presentation, so you can probably imagine that I think it's a good idea. The $3 million survivorship policy. Survivorship, second to die, sometimes called joint life, all mean the same thing. There's a death benefit at the second person's death. Both preferred health. And we ran a number of quotes, a number of proposals. They can pay a lifetime premium of $26,026 to make sure they leave their kids a $3 million policy or $1 million each. Okay, sounds pretty good. If we do the numbers, they're going to pay in much less than $3 million over the course of the policy. But because they're young, maybe they don't want to be saddled with premium payments reminders when they're 95 or 98. So what if we did a shorter pay, 20 pay? There's actually not a huge difference in the premiums there. They're in their 50s, so they might pay premiums for 40 years of $26,000 or 20 years of $32,000. We're front loading the premiums, so it's a little bit higher number, but cumulatively, depending on when they pass away, it's quite a bit less. That 20 pay looks pretty attractive, and we've got the premiums all done, paid off, all set by the time they're in their mid-70s. I also want to look at a 10 pay option. Why a 10 pay? Well, a lot of insurance companies, the 10 pay is sort of their sweet spot on short pricing. If you get to really short pricing, sometimes it's not as efficient. But the 10 pay, I think, maybe because it might be sort of a spreadsheetable number. I think a lot of companies like to compete at that 10 pay. So in this case, I also looked at a 10 pay premium, $62,000. What's sort of the benefit to doing the 10 pay? Well, when we talk about a survivorship policy, I usually ask the client's advisors, how many kids are there? Is there are they looking to use it for any sort of estate tax planning, use an irrevocable life insurance policy? Because if the clients aren't making annual gifts today, then we can use their annual exemption and get those payments almost as high as possible in that annual exemption to use up that annual exemption, because you don't get to go back and say, oh, I didn't use my annual exemption for the last 4 or 5 years, let's make it up. Nope, it's an every year sort of thing. So for them, the annual exemption is $90,000. So if we can get it under $90,000, that's great. We can use up that annual exemption. And what are we doing there? We're actually taking those premiums out of their taxable estate and getting that life insurance death benefit out of their taxable estate. So sort of two things at the same time: reducing their taxable estate and not adding the death benefit to their taxable estate. So the life insurance policy could be held inside of an irrevocable life insurance trust. An attorney draws up a trust, has trustee, has trust beneficiaries. Glenn and Donna make those gifts every year for the kids into the trust. That death benefit being held inside of an ILET actually has its own tax ID number, so it's not ever included in their taxable estate. So that $3 million death benefit, not in their taxable estate, plus the $62,000 in premiums they're paying for the next 10 years. That's coming out of their taxable estate. That life insurance death benefit, because it's in the trust, the trustee's watching out for the trust beneficiaries, the 3 kids. So the proceeds of that are protected from creditors, predators, and divorce, because there's a trustee. The kids don't own that money outright, protected by the life insurance trust wrapper. Also great if Glenn and Donna had minor children. Kids can't get $1 million. They can't write it, can't have a bank account, can't give them $1 million. So the trustee then can manage that life insurance money for the health, education, maintenance, and support of those kids. Now, I also know that a couple of weeks ago, maybe months ago, started getting a lot of emails about grantor trusts, because this was a big deal in some of the earlier versions of the tax reform bills, that grantor trusts, like irrevocable life insurance trusts, were going to have some changes to them. And basically the changes said that any previous ILETs that have been fully funded or any previous gifts are grandfathered into irrevocable life insurance trusts, which are a type of grantor trust. But that subsequent or future gifts could cause partial or total inclusion of that life insurance death benefit, those trust assets, to be brought back into the taxable estate. The most recent version of tax changes had this section cut out. So in the most recent version, there was no wording or language about having any changes to the current way that grantor trusts work. So fingers crossed, ILETs are safe for now, because nobody's talking about it. And it probably doesn't have the same political sizzle as talking about mega backdoor Roths and some of the other things that are in some of the tax provisions. So probably safe for now, might be safe for a long time, for forever, but luckily some of those changes in ILETs, grantor trusts, were removed from or not included in the most recent tax bill. Now, if we don't even want to worry about an ILET, grantor trust, what's an alternative? Well, life insurance trust requires an attorney to set it up. So you got to hire an attorney. And it requires annual crummy letters. These are letters that the trustee and attorney draws up to send to the trust beneficiaries that basically turn those gifts from a future value of life insurance death benefit to present value. So like a lot of things in life, it's just a paperwork step that you have to do to make sure all the T's are crossed and all the I's are dotted. And there's that protection when Glenn and Donna are gone, that there's a trustee who distributes that money at death. So that can be very helpful if there's minors, like I mentioned, can be helpful maybe if somebody who's not very good with money. An alternative would be to have the kids own $1 million policy each. So because the kids own the policy, that $3 million in total is removed from Glenn and Donna's taxable estate. They don't own it. Kids own it, or the ILIT owns it. Instead of gifting the premiums to the ILIT, they gift the premiums directly to the kids. Kids now are the owners of the policies. Kids are direct beneficiaries. So when Glenn and Donna pass away, each kid is going to get a check essentially for $1 million. So what do you want? You want older, responsible kids. Now, Glenn and Donna, they're in their mid-50s. I don't remember how old their kids are. They might be old enough to be responsible, maybe younger, don't know. But this only works if kids are, well, definitely over 18. And if they're in college, may not be the best fit. So that's an alternative to the ILIT that wouldn't ever have any issues with any changes to grantor trust that the IRS might do. So by using the second to die life insurance policy and having somebody else own it, ILIT, kids, they reduce their taxable estate today, which isn't taxable under today's numbers, but could be at some point, reduces that taxable estate, but the premiums they've paid out, the gifts they've made, guarantee an inheritance floor for each kid, $1 million. They're probably going to have some assets left over. The kids will probably get more than $1 million, but now they know that Glenn and Donna know that if nothing else, if they blow through all of their money, kids will make sure they at least get $1 million so they can spend the rest of their assets. And like my grandma Demery, wanting to make sure they left something to their kids, this is a way to do it now with good health, now with current premiums, and reallocating $600,000 now over the next 10 years instead of having to keep $3 million of money on the sidelines, potentially in low volatility assets, to make sure that they're holding that much money instead of using the life insurance policy to pass on that $3 million floor. And the last thing we're going to cover are annuity hybrids. So we talked about the hybrids before, life insurance with a long-term care rider. An annuity with the long-term care rider is probably the simplest version of all of these because there's not a whole lot of bells and whistles to it. So what does it have? Same as any traditional long-term care policy or long-term care hybrid. In order to qualify for long-term care benefits, unable to perform 2 out of 6 activities of daily living or cognitive impairment. When the client accesses the policy for long-term care benefits, not if they just take money out for spending, but through the long-term care provision of the policy, any money paid out are tax-free. Currently, it's available on single premium, non-qualified, fixed annuities. It can't be a variable policy, can't use qualified money, unfortunately. It'd be great if we could use qualified money, because then you could have that money that was tax deferred and eventually could pay tax-free long-term care benefits. The IRS doesn't like that. They want to get their taxes one way or the other. And it's easy to cover spouses or partners with one policy. Like the joint life policy, there's just do you want to have a spouse on the policy or not? So you get this fixed deferred annuity, guaranteed monthly long-term care benefit with a 66-month long-term care pool. And the spouse can be added. And why I say spouse can be added, you can have a policy that starts off where the clients write a check. They're going to be joint owners, joint annuitants, so it works that way. But a lot of times, clients have existing policies. They might have an existing annuity where only one of the spouses is the owner and annuitant. Or you may have a spouse, the primary breadwinner has $100,000 in a whole life insurance policy. And the other spouse, who didn't make as much, maybe has $10,000 or $15,000 in a whole life policy. So it may be lopsided occasionally. The neat thing with the hybrid annuity is that we can do a 1035 exchange from an existing policy on just one spouse to an hybrid annuity and add this partner on as someone eligible to receive the long-term care benefits from the policy. It's a really neat thing that is just, it's sort of this little nuance, but it's really cool that we can take annuity on her and now have an annuity that has long-term care benefits for her and him. So here's Howard, he's 75, he has an annuity. $578,000, about $200,000 of gain. So if he surrendered this annuity, he's going to owe ordinary income tax on $200,000. He's not going to surrender it, but they sort of have thought of this in the back of their minds as, this might be an annuity that we'd use for long-term care. It's, if we ever needed it. And if they do, let's say he starts taking out $5,000 a month. That first $200,000 he takes out is taxed as ordinary income. Annuities are great for deferring gains. They're not so great when you take the money out. So all the earnings come out first and they're taxed as ordinary income. So not a great way to do that. It's an option, but is there a better way? I think so. Especially because Howard has Maryland. And their advisor said, let's look at how do we look at some long-term care planning for both of them. But we have this one asset that's only in Howard's name. And couples want to do everything together. They want to walk, they want to do piggyback on the beach together. They want to stand in front of a blue wall together. Want to maybe share breakfast together. I don't know if they're going to share or not. They want to get lost together. They want to do everything together. And long-term care is no different. Where are they? Well, normally they're in San Francisco, California. In the previous picture, they're lost looking at the map. So hopefully they're not at home. If they are, then we may have a cognitive impairment issue. But they're lost somewhere else. At home, they know exactly where they are. They're in San Francisco, California. Where are the costs for care? Home, assisted living facility, hover right at the $6,100 number. Private home, private nursing home room, remember it was $9,500 in Ohio. Now we're talking $15,000 a year or a month in San Francisco area. So those are sort of the numbers in the area that we're looking at. I looked at a few different options for the clients and their advisor. First one was just, if we used $100,000 rollover from the existing annuity, what would that get us? $100,000 just being a nice round number. Gets us about a $220,000 pool of long-term care benefits. So $33.29 per month for 66 months. So it's $33.29 per person for a combined total of 66 months. If they both went on claim at the same time, then the policy could actually draw down on the policy at $6,600 per month. Howard and Marilyn are each getting their own $33.29, so it's $6,600 a month coming out of that $219,000 pool. So if you think of it a different way, if they're each spending down $33.29, each $33.29 they spend down is a month. So instead of $33.29 for 66 linear months, we've got $33.29 times 2, so 33 months. So they'd be getting $6,600 from the policy for 33 months linearly for $220,000. Oh, good question. What's the application process for this? Medical exams. For the hybrid annuity, most of the time there is no exam. There's an application that we help the clients with. The insurance company is likely to order medical records. And more often than not, there's a cognitive screening interview. And a lot of, they don't tell us exactly what the questions are, but sometimes it's things like, I'm going to say these 5 words: coffee cup, calculator, banana, lamp, car. You can tell I'm just looking around at my office. Say those 5 things, repeat them to me. Don't write them down. Then the interviewer asks a handful of other questions, says, okay, on those questions I asked, tell me how many you can remember. So they're looking for cognitive, in that case, what's your recall? So they're looking for cognitive. But generally, no exam unless somebody hasn't gone to the doctor in a long time. But for more often than not, people who are 75, 71 probably are seeing a doctor regularly, so it's not that often. Good question. Number two option that we looked at was $185,000. So taking $185,000 and doing a partial 1035 exchange from that existing annuity to a hybrid long-term care annuity. I picked $185,000 because now we have a shared pool of $406,000 at $6,100 a month. Remember, $6,100 a month was that home health care average monthly expense, that assisted living healthcare expense, because 70% of all care is provided in home or in the community or assisted living settings. Remember, I said almost 90% of first-time claims is in those facilities. Overall, about 70% of care is received in those areas. So it's going to cover a lot of that initial monthly expense. Wherever they might receive care today, it's going to cover a lot of the expenses. Now, if they go into a nursing home, and it was $15,000, I think I said, they're on, they're going to be self-insuring essentially for that difference. But the $6,100 per month should be paid wherever they are. And then I looked at another idea. What if we took half of the annuity, $289,000 rollover, $9,600 a month? Covers about a little over 60% of today's private nursing home room costs. Is more than the home healthcare numbers right now, but we know costs for things are increasing, and so that home healthcare of $6,100 is probably going to increase every year. Where with this particular annuity, the $6,100 isn't increasing, just to make numbers nice and simple. So what's the benefit here? Well, we're preserving $200,000 to $600,000 of other assets from being spent down if they need long-term care. It's more tax efficient than taking money out of the annuity directly, and we get to leverage that money. If they took $100,000 out of the annuity to pay for care, they get $100,000 to pay for care. That $100,000 turned into a hybrid annuity gives them $220,000 to pay for care. So we're just a little over doubling the benefits there if they need care. Good tax treatment. Another thing that I forgot to mention here is that if they don't use it for long-term care, then their kids get the annuity values, or they decide they don't need it for long-term care for some reason. They can cash it in and get the annuity values. It has less stringent underwriting than traditional long-term care options. So even though the application is fairly similar, application, medical records, cognitive interview, it's usually more flexible. Usually, I think because it's a big upfront premium, and they get to share the policy together, kind of like a tandem bike. They're able to have this one policy, even though it may have been his cash value policy, his cash value life insurance policy, or her annuity. They can transfer into something that allows them both to access the policy for long-term care benefits. So thank you all for tuning in today. I've had some questions come along, and as I went along, if you have any questions now as we're wrapping up, please feel free to chime in, and I'll jump in as I see them. I mentioned this, I teased with this at the beginning. Come to our Insurance Academy, Sheridan Sand Key, Clearwater Beach, end of February. It's going to be beautiful. I would like to say that the skies are going to look like that. We got a 50-50 shot, and I think that we've got a more than 50-50 shot of it being warmer than wherever you're coming from. It's not always warm at the end of February, but it's probably warmer than where you're coming from. And yes, the hybrid annuity is only on a fixed annuity, not variable. That's correct. And for those of you who are new to us or just haven't tuned in a while, We do monthly webinars for fee-only advisors every year, most every month. We haven't figured out what our next one is. We're working on our academy presentations right now, so that will be coming soon. But that's one of the ways that we try to add value to you as fee-only advisors, and because you don't do insurance every day, we do, and want to give you ideas for just when you're meeting with clients and looking at clients' plans, what are any triggers or things to think we might need to look into that. But at the end of the day, we're not your competition. We only work with fee-only advisors and their clients. And one of the things we like to do is save you time and your clients money when it comes to all things insurance. One of the ways we do it is pre-underwriting, getting clients information ahead of time to avoid surprises in the application process, and trying to match them up with the right company, the right time, the first time right away. Because if they use marijuana or on different medications, different height and weight, insurance companies all look at that a little bit differently. And we're a proud sponsor of a number of different fee-only planning firms, and we recently became a sponsor of BLX that's working with trying to find internships to match up people in the Black and Latinx financial planning world with fee-only planners who are looking for people, and so we're excited for that to help them along the way and try to match people up. We have specialists in life, disability, long-term care, annuities, and hybrids. We help manage your clients' policies. We watch out for clients, make sure that they pay their premiums on time, let you and the clients know if their term policies are expiring. We have our Alice advisor portal where you and your clients can get information, and it's always available 24/7. Thank you, everybody. Happy holidays to everybody. Remember to complete the survey when this is over. And if you have any questions that come to mind that you didn't think about right now, but as soon as I click off, they're going to pop right into your head, I'm sure. So happy holidays to everybody. Have a great end of 2021, and we look forward to working with all of you in 2022. Bye.